All right, so we were talking about the lead in of the Social Security report, okay? So we're doing the workshop, person comes in, they're after that Social Security report. What we can do though at the workshop is we can actually offer some additional reports, right? Like a Morningstar analysis, a testing of your current financial plan. We can kind of offer all that stuff so it's not just about a Social Security report, okay? The other thing is good to do too is those common complaints that we had a minute ago. It's a good idea to put those on your response sheet and have a client check off what their common complaints are. So that way your gun is loaded, okay? So they're still going to come in for the Social Security report, but in addition to that, on your response sheet, you're going to say, okay, and this is what 𝘃𝗃𝗃𝗀𝗃𝗃𝗃 does, by the way. He's running the same courses you guys and gals are. This is what he's done. I've been to his workshop, okay? So he puts on the Social Security report, talks about how the Social Security is going to be a guaranteed source of income, and we want to use that Social Security to fill our non-discretionary expenses, right? So that's food, water, shelter, clothing, health care, transportation, a roof over your head, right? Anything that you have to have any quality of life in retirement at all, okay? And then what we're going to do is look at what you have coming in and what you need coming in, and we're going to identify an income gap. And then we got to find out how you're going to invest your assets to cover that income gap. All right, so in addition to that, we're going to look at a Morningstar analysis on your current investments to kind of see where things are, tell you what your risk is, how much you could lose in the next major market crash. And by the way, folks, you'll see 3 more in your lifetime, okay? And then what we're going to do is we're going to show you a way to test out what you're currently doing with your money, and look at the probability of success on that. We're going to test any ideas that you have. Maybe you thought about, buying yourself a variable annuity or something like that. Well, how do you know if that's going to work out for you other than the advisor saying it's going to work out for you? I would like to quantify that, right? That it's going to work out for me, okay? And then we can test what you're currently doing, and then we can also show you some ideas to help make your situation better. And that's kind of how you would preface it at a workshop. So if you preface it like that at the end of your workshop, what happens next is when they come in, they're not just expecting that Social Security report, all right? And what are you doing there? Do I smell heat? Did somebody turn the heat on? Are you nuts? All right. So what you're doing is you're kind of prefacing that so that when they come in, they're not just expecting to walk in and get a Social Security report and leave, okay? And so that's very, very helpful, and you can make that Social Security report a part of your second appointment process to actually delivering your presentation. All right, could somebody do me a favor and just turn the AC off instead of hot? I'm from Texas. You guys are up here in Maine. I know you guys are cold-blooded, I'm warm-blooded and that sort of thing, but I can't, that ain't gonna work, all right? Okay, so now, once we've gone through the pyramid, okay, we've teed it up at the workshop, clients come in, we've kind of gone through the pyramid, we've got our advanced commitments down, we understand where we're going, what the process looks like, and we've got a commitment, we can start moving into a presentation phase. And so the presentation phase is designed to eliminate any objection that a client could have, okay? Man, that's getting hot in here, guys. So the first thing we want to do is we want to understand something. Remember the Beth Rule lady I told you about? What was she concerned about? Was it about running out of money? Was it about market crash? No. What was it about? Me being able to steal her money, okay? So let's kind of talk about that and spend some time on that, right? So what I'm going to do is on a whiteboard, and I'm actually working on building this out in a PowerPoint for everyone as well. I'm going to draw a couple lines on a page that are T, and you'll see that most of my presentations are based around this T, okay? And where I'm going to begin talking is I'm going to talk about retail versus wholesale. Do me a favor. If you sit here and write down everything that I say, you're going to miss half of what I'm talking about and only write it down. You're not going to be able to use it. This is a whiteboard presentation. Everything that I write down here will be here, and I promise you, you will have these slides. So take notes. Don't write down what I say. Take notes where I say things and make inflection points, okay? But don't write down everything, because I will give you these slides, and that way you can retain more of the information. I do that a lot, by the way. I sit there, write down everything somebody says, and then I leave, and I'm like, what the hell did they say? All right? So, okay. So retail versus wholesale financial services. And a lot of people don't know the difference between these two, and this is a very big deal because a lot of people are in a retail relationship and shouldn't be in a retail relationship, and a lot of people don't even know the wholesale world exists in the first place. And I don't know about you, Mr. and Mrs. Jones, but if I'm going to buy something, I would much rather pay a wholesale price than a retail price. Would you agree with that? Absolutely. So let's talk about the differences between these two and why it's important to understand. The first thing is, let's say that back in the day, you saved 6 months of living expenses, so if you lost your job, you had time to rebound, so you had that covered, and maybe on top of that, you saved, I don't know, 20,000 bucks. And you decide to yourself that you've heard you want to invest your money because that's prudent to do, and let your dollars work for you and that sort of thing. So you decide that you want to invest in the stock market. Well, you have no idea how to do that. So you go get your car, you drive down to a retail strip center, and you go in and talk to a financial advisor in one of these retail strip centers. You say, hey, I've got $20,000. I know it's smart to invest. I want to invest in some stocks. And the financial advisor there says, well, what do you know about picking stocks? And you say, I don't know anything. He says, well, I've got a better idea. How about we put you into a mutual fund where you get instant diversification across hundreds of stocks, all right? And you get a professional money manager to boot. And you say, hey, that sounds pretty good, all right? So what happens there is when that advisor puts you in that mutual fund, they're going to take 5% up front day one and earn a $1,000 commission. Awesome. Thank God for those advisors, because so many of us got our start there, okay? And if it wasn't for them, a lot of us would be investing to where we are now. Now here's the problem. Over time, you save more money because you're smart, your investments grow, and what happens is when you get to around $200,000 in assets, what should happen is you should move over here to the wholesale world, but that's never going to happen. And here's why. When you get to $200,000 in assets, and that same financial advisor sells you $200,000 worth of mutual funds, guess what? They take $10,000 off the top and put that in their pocket. Now, I told you there's nothing wrong with investing $20,000 into a mutual fund and paying a small commission. That's how advisors make their money. They have a right to earn a living the same way you do, all right? The challenge is when you get to around $200,000 in assets, the advisor makes a $10,000 upfront commission day one, okay? And the thing is they did nothing different between the $20,000 mutual fund investment and the $200,000 mutual fund investment. Took the same amount of time, did it? Okay? So what's interesting about this is this now changes the dynamics of the relationship. And how it changes the dynamics of the relationship is, what do you think that advisor is focused on going forward? Is that advisor focused on making sure that mutual fund expectation that they painted in your mind is actually working out and performing as it should? Or are they more focused on going to find more people to sell $200,000 worth of mutual funds to? What do you think? No question about it, okay? In fact, the way the system works is that these advisors, by the way, they don't work for you, they work for the company they represent. So some examples of that. And they're also, not only do they work for the company they represent, they're also captive to this company. So why is that important? Well, it's important because I feel like an advisor should have your best interest in mind and work for you, all right? And in the scenario, what's happening is these advisors have additional motivation to go out and sell more commission because these retail shops have these things called commission grids. And the more these advisors sell, the higher up these commission grids they go, and they get paid retroactive $1 to the assets they sold that year, and they make more and more money. So it's really driven to generate commission and not benefit you, the client. Now, the captive thing is interesting because what you don't realize is that they're captive, and the reason why they're captive is they're given a set menu of products and services they can offer the people that walk into the door. So on that set menu are oftentimes these things called proprietary products. And these proprietary products pay an advisor a massive commission on the front end, all right? And the internal expenses of the products are also going back to the house as well. So a 5% commissionable product at a retail shop could actually be a total of 8 to 10% a year in cost to you. You're only going to know about 5% of cost. The rest of it you're never going to know about because this is a non-transparent world that they don't have to tell you to disclose this stuff to you, all right? And I think that's a disservice. So in addition to that, these companies also appear to have custody of your funds. So when you invest your money with Edward Jones or Raymond James, you think Edward Jones or Raymond James has your funds. But guess what? That's not the case. Your funds are actually likely held at a custodian called Pershing, who is one of the largest broker-dealer custodians in the world. Okay? So that's kind of the retail relationship. Now, what happens here is when you get to $200,000 in assets, you should be able to move over to the wholesale world. But there's a reason why you have not heard of the wholesale world at $20,000 in assets. And here's why that works. In the wholesale world, we're not commission-based, we're fee-based. And in the wholesale world, we're going to charge, say, 1% of your account value over a year's time. And 1% of $20,000 is $200. So over the course of that year of managing your account, we're going to charge you $200 to manage your account. Okay? Now, I'm not saying that my fee in this company is 1%. My fee ranges depending on how much money you put with us. Okay? I'm using 1% as an example. All right? I say that because people go, oh, Ryan, you said your fee was 1%. No, it's not what I said. I'm using this as an example for easy math because I'm a dumb redneck from Alabama. Okay? So basically what this means is this account's generating $200 a year. Well, you know, there's cost of doing business in every business model. And my business model is no different. And the cost of an account is the same if it's $20,000 or $200,000. The problem is a $20,000 account doesn't meet our cost. It does not create a profitable relationship. Now, make no mistake about it, Ms. Jones, if you have smaller accounts, we'll certainly work with those, okay? But keep in mind, we have to be profitable to stay in business because I have other clients that depend on me, and I've got to stay in business to serve them. Now, what happens is when you get to $200,000 in assets, and I'm charging you a 1% advisor fee, that means we're making $2,000 a year. That is enough revenue to cover my costs and generate a profit for my company. And that's why you likely have not heard of the retail or the wholesale world with $20,000 of assets, but we should know about it. And in fact, this guy over here in this retail relationship, what they should be doing is when you get to $200,000, they say, hey, go call Ryan. You need to go to Ryan. You now qualify to do that. I'm going to go find some more people to bring up and bring to Ryan. That's exactly what they should be doing. That was actually the model, by the way, but it changed somewhere along the path. Now, what's interesting about this relationship, as we talked about a minute ago, once this advisor right here sells you this $200,000 mutual fund that you're expecting an 8% average annual return on a year, all right, are they worried about you getting that 8% average annual return? Or are they worried about going to go out and find more people to sell more commissionable mutual funds to? Yeah, they're more worried about that. They don't care about 8%, okay? In fact, they don't want you to get 8%, so they can swap you out from that fund to another to make another commission. And that's the reality, all right? So what happens with us is a little bit different. And the reason why it's different is because as your asset value grows from $200,000 to $400,000 over time, did you make more money? Yes, you did. All right, well, guess what? Our fee is still 1% of your account value. So as you made more money, we made more money. So now we have a situation to where our value system is aligned. And we want your accounts to grow because there's two ways I make money in my business: by bringing on new clients and making sure my existing clients are taken care of and their portfolios are performing the way that they should. You know what I'm more focused on than anything else? I'm focused on making sure my clients are happy, right? Because happy clients equals happy life. And I want to make sure your accounts are performing the way we expect them to. And if they're not performing the way we expect them to, we're going to be there to make changes, all right? So if your account value goes down, guess what happens to my fee? It goes down. So as your account value increases, we make more money together. As your account value goes down, we lose money together. So we feel victories together, but we also feel pain together. So now you can see that instead of worrying about finding more people to sell commissionable mutual funds to, I'm actually worried about your accounts performing the way we expect, and I'm standing by to make changes in the event that they're not. All right? So the next thing is we don't work for a company. We work for you, the client, and we have no set menu. And this is really important. You pay me, Mr. and Mrs. Jones. Those fees are coming out of your account balance. Now, make no mistake about it, they're coming out of your account balance at a much larger scale than the other relationship, The difference is you actually see what you're paying me, because every single month when we bill your accounts, you're going to see cie__𝗂𝗂𝗁 an exact amount of money that you're paying me. So I better be delivering value, because if I'm not delivering value for the fees that you're paying me, what are you going to do? You're going to fire me, right? And that's a good point that I bring up there, because what I want you to understand is this is your money. You're in the driver's seat. You're in control. You can hire me or fire me at any time you want to, and I better be delivering value for the fees that I'm charging. The no set menu thing. What a lot of people don't realize is that these advisors are given a set menu of products and services they can offer the people that walk into the door. But oftentimes there may be things on that set that are maybe things that are not on that set menu that you may like better. But you're never going to know about them, are you? See, with us, we have no set menu. We are independent. And independent is very, very important. All right, and the reason why I'm saying this word is because independence allows us to go anywhere we want to go. So I have relationships with TD Ameritrade. I have relationships with Fidelity. I have the ability to put you in stocks, bonds, commodities, real estate, mutual funds. I can put you into annuities. If you want to buy life insurance, we can buy life insurance. I can go anywhere I need to go because I don't have some company dictating what I can sell to people that walk through my door, or put people in that walk through my door. So independence a lot of times is often confused with the word small, because I'm not a Merrill Lynch, I'm not a Morgan Stanley, I'm not a Raymond James, and guess what? I'm never going to be, and never do I want to be. All right? I have the firepower behind me through Foundation's investment advisors, through our money management teams, through Fidelity and TD Ameritrade, and I am just as big and just as capable as all those other companies will ever be. All right? And furthermore, I'm probably more capable. Okay? Now, the other thing we got to talk about, though, is if I'm independent, where's your money? See, our custodian, so the person who's holding custody of your funds are going to be TD Ameritrade or Fidelity Investments. So I don't ever want you to write a check to a financial advisor, Mr. and Mrs. Jones, unless the financial advisor is handing you an invoice for a written comprehensive financial plan. That is the only way you ever do that, all right? You do not write a $100,000 check to Allied Wealth to invest in the stock market. You don't do that. That's how Bernard Madoff pulled off what he did, by the way, is he had custody of people's funds, okay? So in this scenario, what I'm trying to illustrate to you is if you want to do business with us and you want to engage with us, you're going to write a check to TD Ameritrade or Fidelity. You're going to open an account with TD Ameritrade or Fidelity. We're going to do that for you because we have access to their platform, all right? And what's going to happen there is when you open that account, your account statement is going to come from TD Ameritrade. When you log online to see what's going on in your account, guess whose website you're logging into? TD Ameritrade. When you want to start income payments later on from this account, when you get EFTs coming from into your account, guess where they're coming from? TD Ameritrade. So the point is TD Ameritrade has custody of your funds. And all we do inside of your account is manage the accounts according to your risk tolerance and your capacity to take risk. Pretty cool. So that is wholesale versus retail financial services. All right, and we call this Module 1. Now, there is something I have been going to recently to answer your question, and what I'm telling people is, hey, Ryan, I understand you're fee-based, but so is my current advisor. Well, who's your current advisor with? Oh, they're with Morgan Stanley. Or I love this one, they're with Fidelity. Okay, you'll get this a lot, by the way, in bigger cities. And they have me in this PAS system, and their fee's only 60 basis points. I'm like, okay. So here's what's going on. In that PAS system, Portfolio Advisory Service System for higher net worth people, what's happening is you're being duped. Oh, I'm not being duped. What are you talking about? No, you are being duped. And the reason why you're being duped is Fidelity is engaged in what we call a hybrid relationship. If you look at that PAS system, you're going to see that all of your money is invested where? Fidelity mutual funds. Okay? The advisor's charging you 60 to 70 bips on the front end, and you think that's all you're paying on the back end. But the reality is that's not the case. Fidelity has you in Fidelity mutual funds, and they're making internal expense ratios on those mutual funds. Okay? In addition to that, what you're not seeing that's hidden from you in there is the cost of trading those mutual funds. Guess what trade desk runs the trades on those mutual funds? Fidelity's trading desk. And guess what? Fidelity's making those commissions on those trades too. And those commissions come right out of your return and impact your bottom line. So you're absolutely paying substantially more for that stuff, okay? So that's where you would tie in that hybrid model. And what that does is it paints egg on the face of the retail guys, and it paints eggs on the face of the people out there. They're saying, yeah, I'm a fee-based advisor, but the reality is I'm charging you a commission or putting good funds my company's making a kickback on. Did that help you out? Yeah. Okay. Any questions on this? All right, so guys and gals, we called this portion right here, this is module 1. All right. So, and what am I doing, by the way, with this module? What's happening here? Anybody know?
Differentiating yourself from others.
I'm differentiating myself from others. I'm breaking down the barriers. I'm answering client objections. I'm getting them comfortable with investing money with my firm and how it works. I'm basically painting a picture that I'm on their side. I don't think that this stuff right here, this hybrid stuff or this retail stuff should be happening. I'm telling them that as their accounts grow, I make more money. If their account goes down, I lose money, right? I'm telling them that I have no set menu, so I can go anywhere they want to go as long as their goals and what they're trying to accomplish is sensible, right? Don't come in my office with $100,000 expecting $1 million income in retirement because I'm not going to work with you, okay? I'm also telling them where their assets are custody, building that trust level with the clients because they're all thinking that you hold their money, by the way. They are, okay? And I'm breaking down those barriers and handling those objections before they come up on the front end. Okay, now, so listen, Ms. Jones, now that you kind of understand the wholesale versus retail financial services picture, okay, let's kind of talk about what it is we're trying to accomplish. Because what I'm looking at here is I am looking at a couple things. I am looking at your income sources. Versus your non-discretionary expenses. Okay? So when I ask you today, what is the cost of food, water, shelter, clothing, medicine, transportation, by the way, some clients even say vacations, okay? What do you think your expenses are going forward in retirement? Well, Ryan, they are $70,000 a year. Okay, cool. All right, your income sources in retirement are going to be what? Well, Ryan, I have a pension of, say, $10,000 a year, okay? And I have, between my wife and I, we have Social Security estimated income of, say, $30,000 a year. Okay, I'm making these numbers up, guys and gals, all right? Okay, cool. So basically what we have is $40,000 a year in income from guaranteed sources. That's awesome, okay? And then we have a difference between our income and non-discretionary expenses of a negative $30,000. And whether you realize it or not, what you're here to do is to figure out how you're going to make the assets you have generate that income to cover your non-discretionary expenses as long as you have breath in your body, right? Yeah. And just as a side, I'm curious, if I needed $30,000 a year in income, right, to cover my non-discretionary expenses so I always have food, water, shelter, clothing, medicine, transportation, and retirement, how much of that $30,000 your income gap would you like to have guaranteed as long as you have breath in your body? And guess what they're going to say? All of it. So what did I just tee up there, by the way? Okay. Now there are several ways we can guarantee that income for life, Mr. and Mrs. Jones. There's only a few things that will do it, there's different options out there available to do that, and so we'll talk more about that. But if that's important to you, that's something that we certainly can go down the road of. And by the way, if I build a plan for you that provides that $30,000 a year in income as long as you have breath in your body, regardless of what happens with the stock market, the economy, or interest rates, do you feel like you and I would have a basis to do business? Yes, I do, Ryan. Yes, I do. So we're continuously getting that commitment as we go through this, okay? All right, so that is module 2. Very short, very sweet. Now, why am I saying modules 1 and modules 2 here? Well, I just kind of alluded to it. I just shared with you that I'm a pilot, okay? And I actually went to flight school in 1998, 1999. Kicked butt, made straight A's, was ace of the base, all that kind of stuff. And the terrorist attacks happened in 2001 and really derailed my aviation career. And I'm very grateful for that because it allowed me to get to where I am now. And I see airline pilots walk into the airport. My dad's one. And it makes me question if that's really what I would want to be doing at this point in time in my life, all right? So at any rate, I have a lot of experience in aviation as a result of that. And what we're trying to build is a sales process that works just like this. A 747 can be parked at the gate at the airport. The captain drives from the western United States to the airport. The co-pilot drives from the eastern United States to the airport. These guys have never met each other, never talked to each other, ever. They get in the cockpit, they shake hands, hi, I'm Bill, hi, I'm Bob, how you doing? And guess what they do? They fly the plane. They can fly that airplane around the world, and that airplane can throw every single emergency at them, every single one. Smoke in the cockpit, engine fire, low fuel light, too much imbalance because fuel's too much on the left side of the airplane instead of the right side of the airplane. Whatever that emergency is, those two pilots can handle it. Why? Training. They have been trained the exact same way. It's called standardized training. So if I can build this stuff for you guys and gals, and I did this, by the way, for previous advisors and grew our AUM book from $500 million to $2.1 billion, okay? Guess who got the benefit from that, by the way? Every person in this room's book, in the room, their book grew. They made more money, okay? And as Brian says, yes, we're not working for the church, we're making more money too, but if we don't make more money, you guys don't make more money, and vice versa, okay? So the point is we're designing the system so that if you get out there and you're getting stuck, I can say, show me module 1. Well, Ryan, I'm not using module 1. Hey, no problem. Do you feel like there's some areas where you could have used module 1? Or hey, Ryan, show me module 2. Well, module 2, you didn't identify the income gap and talk about how to cover that guarantee for life, right? So what this allows us to do is kind of break down where you are in your sales process and figure out where problems are, and we can pinpoint the problems and get you back on the right track. All right? All right, so module 3. Here's module 3. Module 3, we talk about the different ways you can invest your money. All right? So there's different ways to invest money to fill your income gap. We've already talked about how you'd like to have as much of that guarantee for life as you possibly can. Okay? So the first way you can do this is you can be not in the market. All right? Now, contrary to popular belief, there's been this value instilled in us that we have to have our money on Wall Street, in the stock market, in the bond market to generate the income we need to have the lifestyle we want to live in retirement. And guess what, folks? That is absolutely not true. There are other ways to do this that don't take risk with their money, that are out of the market altogether. And a lot of us don't know about these things because all these brokers over these years with these set menus, these things aren't on these set menus and they typically can't offer them to you, all right? So, and that's why working with an independent advisor like myself is very important. So, what these programs do is offer you growth of money with, my favorite word, safety. So you get growth with safety. In these programs, you get market upside with limited to no downside. Any investment requires some type of time commitment on your funds. There are investments that require short term, like a bank CD of 1 to 2 years. There are investments like 30-year bonds that require 30 years. Any investment is going to require some type of time commitment on your funds. These particular programs, their time commitments are anywhere from 6 to 10 years in most cases. And they offer the ability to earn anywhere from 4 to as much as 8% per year each year over a 10-year period. And those are programs that are not in the market at all. The next way you can invest your money is you can be in the market but you can be passive. And have you ever heard of Vanguard funds? Yes. A man named Jack Bogle founded Vanguard Funds. And Jack's whole thing is that just buy the market because you can't beat the market, right? And that's called passive investing. Well, the cool thing about passive investing is you get 100% of market gains. That's awesome, right? But you also get 100% of market losses. Now, passive investing is a very low-cost form of investing, right? And so it's low cost. However, passive investing requires the longest time commitment of any mode of managing or investing money. And passive investing can take as long as 10 to 30 years to play out. Let's put that in perspective for a minute. Let's go back to the year 2000 when the S&P 500 was at about 1550. The stock market was at 1550. From 2000 to 2001 to 2002, the stock market fell to about 650. It rose back up in 2000 and in 2007, it hit 1550-ish again. Then 08, 09 happened, and the market goes back down to about 650. And then how long did it take after the 08, 09 crash for the market to hit 1550 again? Anybody know?
2010, 6 years, 4 years.
I've heard 6, 2010, 4 years. The answer is almost 2015. About halfway through 2014, about 3/4 away, the S&P hit 1550 again. So if this time period is from the year 2000 to the year 2015, how long was that time period? It's 15 years. And it's 15 years of near zero returns in the market. Why did I say near, by the way? Because there's going to be some jackass out there that says, oh, because the S&P 500 pays dividends at 3% a year. Okay? So near zero return in that time period. All right? Now, I don't know about you, Mr. and Mrs. Jones, but if I need a 6% return on my money in retirement to generate the income I need over my lifetime, I don't have 15 years of no returns in the cards. That's not going to work for me. Okay? So keep that in mind. Now, my point is it takes as long as 10 to 30 years for this to play out. It's the longest investment time vehicle out there, okay? Why am I saying that, by the way? Think about it. I'm saying that because I'm getting away, and by the way, I'm saying that because I'm getting away from the 6 to 10 years on, what is this over here, by the way? What is this? No, it's not an annuity. No, there's several things, hold on, there's several things that do that, Mr. Jones. There's these things called structured products, there's index-linked CDs, there's various indexing strategies, there's all kind of vehicles out there that do that. Right? Because that person right then, what are they trying to do? Exactly. They're trying to screen you out. Oh, he said annuity, I'm out. No matter what he says from this point forward, the guy said the 4-letter word, I'm not paying attention anymore. Forget this guy. All right? There's several programs that do that. There's index-linked CDs, there's structured products, there's indexing strategies, several programs do that. So you said, is that an annuity, right? I said there's several products that do that. I didn't say, no, it's not an annuity. I said there's several products that do that. See the difference? There's index-linked CDs, there's structured products, there's indexing strategies. There's all kinds of products that do that. So I agree with you without saying it's an annuity. It's very important there, what I did there, okay? Now, the next thing.
It's shorter term than passive.
That's exactly right. It's short, that 6 to 10 year time frame just that goes out the window when I'm talking 10 to 30 years over here, okay? Now, I'm in Texas, by the way. We're an 80-10-10 state, compact states. I don't know about Maine, what your regulations are up here or not, but the max we can sell is 10-year annuities. So if yours is 6 to 12, what is it, Ray? Are you guys compact up here? What's the longest term annuity you guys sell? 12. So you're not, okay. So all you do is say instead of 6 to 10 years, it's 6 to 12 years, okay? No difference, all right? I'm putting that up there because I'm in Texas, and that's what we've got in Texas. So now, let's kind of talk about what this looks like for you. Because if you're going to go down this path, you literally have to get your statement in the mail. When it comes in, stick it in the drawer and never look at it again. Okay? That's what you have to do. So let's find out if you can actually do that or not. Let's kind of test this theory a little bit. And let's look at this strategy in 2008 and in 2009. Okay? So 2008, 2009, kind of look what this looks like. In 2008, the market lost about 38%. Now, I told you that this passive investing model is low cost. I did not say it was free. So let's say that you lost 38% in 08 and you paid a 0.5% fee as well. All right? But then we always know the market always comes back, right, Mr. and Mrs. Jones? Right? You've heard that, okay? And it does over time, but time is the most valuable commodity that you have at 65 years of age. All right? So in 2009, the market came up 23%. And in that 23%, let's say that you still paid a 0.5% fee that year. All right? So let's kind of look at this. You've got $1 million. And if you do the math on that, what you're going to find out is that $1 million portfolio over that 2-year time period, not taking into account any distributions you took out for income purposes or vacations or taking the grandkids to Disney World or buying a car, whatever it is, not counting that, okay? You lost 25%, which equates to $250,000, and your portfolio value is now worth $750,000. Here's how you determine right now, Mr. and Mrs. Jones, if a passive approach is appropriate for you. Ms. Jones, if your portfolio dropped from $1 million down to $250,000 in a 2-year period in retirement, would that cause you to consider changing your lifestyle? Well, yeah, Ryan, it would. Ms. Jones, I'm just curious. How does that make you feel about working the last 30 years to save this money, going without, saving, to have your lifestyle change in retirement as a result of a market crash such as this? How does that make you feel? Does that concern you? Is that something you're worried about? Now, notice I talked to Mrs. Jones. I didn't talk to Mr. Jones. And I really don't give a crap about Mr. Jones because I know who makes the decisions. Always. Okay? As macho as I want to be and think that I make the decisions, here's the way it is in my house, okay? Ryan is the head of the household. That is correct. However, I, 𝘃𝗂𝗂𝗂𝗂𝗃, am the head, or the neck that turns the head. Okay? All right? So think about that, okay? So, the other way you can invest money is in the market. Yes, okay? In the market, but you can take a tactical approach. All right? Now, tactical money management is the most misunderstood form of money management that there is. And the reason why is tactical management is only designed to get about 70% of the market's gains. And here's why it's misunderstood. Ryan, I don't understand something. I am paying you to manage my money. And what I see is that the S&P 500 did 10% last year, and you only did 7%. I could have gone and bought a Vanguard S&P 500 index fund and done a better job than you. And I'm going to say, you know what? You are exactly right. You could have, okay? But the way we've chosen to allocate your capital is take a tactical approach. And the reason why we're doing that is we're designed to get 70% of market gains. So there's going to be years when you come in here and the market did 10 and we only did 7. But remember, we manage money in this capacity because our portfolios are also designed to get no more than 30% of market losses. So what we're doing is we're giving some upside potential up to build in some safety and protection there so we don't have a drawdown of 50 or 60% in our portfolio if another financial crisis occurs or another Great Depression occurs or another Black Friday occurs or another tech crash occurs, right? See, Mr. and Mrs. Jones, understand something. It is not my job to make you wealthy. That was your job, and you've done a damn good job of it. What you've come to me to do is generate the income you need in retirement, take a lifestyle change off the table, and keep you wealthy. And how I do that is utilizing this type of approach if you want to go down that road. All right? Now, tactical investing comes at a much higher cost than index or passive investing. Okay? In addition to that, the time commitment on tactical investing is anywhere from 4 to 7 years. Every 4 to 7 years, the market should cycle, And during a complete market cycle, about 70–80% of the time, a tactically managed portfolio will wind up beating the market and doing a better job. Not always, it's not perfect, but in most cases it will. All right, now you're looking at me like, wait a minute, there's no time commitment on this. There's not. Your money, as you know, your money's 100% liquid at all times. Okay, so now, so let's kind of look at the impacts of this in the same scenario, the 2008-2009 scenario, and let's assume that we get no more than 30% of the loss in 2008, which was 38%. You don't have to draw it over here, just kind of go back over and highlight it, right? And we get 70% of the gain in 08, okay? Now remember, you're paying me to only get 30% of the loss, or about 30% of the loss, to get 70% of the gain, right? So that means it's not free to do this, and it comes at a higher cost. So let's just say that you paid a 1.8% fee in 08 and a 1.8% fee in 2009. Well, if you do the math on this, which I have many times, what you will see is that in this same scenario, your $1 million portfolio value would have dropped about $30,000, would have dropped 3%, or about $30,000 to $970,000. Now, if you look at the difference between these two numbers, it's about $220,000. Is that right? $250,000? It's about $250,000 in difference. Okay? Now, you paid 1.8% fee, assuming $1 million balance in 08. You paid another 1.8% fee in 2009, assuming the same $1 million balance, right? So that means you paid $36,000 in fees. Okay? So, Mr. Jones, I'm just curious. Would you spend $36,000 to receive $250,000 in return? Yes or no? In this scenario, which ones of these would you rather have? Well, if you're telling me you would rather be in the 970 scenario and you understand this whole tactical money management thing, what you basically just told me is you prefer tactically managed money over in the market passive money. Okay? Now remember, I'm having this conversation with you because previously, in our previous module, we were talking about your income gap. And we have to invest your money in a manner to solve for that income gap and inflation for as long as you have breath in your body. And that could be 35 or 40 years. So these are the methodologies, whether you go to me or Edward Jones or Morgan Stanley or Ray J or anywhere else. These are the basic methodologies that you can use to invest your money. So based on this information, which one or which ones in combination of these programs would you like me to give you more information on? And what do you think they're going to say?
1 and 3.
1 and 3, every single time. On occasion, you will get somebody that says all 3. Can we offer all 3? Yeah, because we have our new intelligent index portfolios at Foundations Investment Advisors. So yeah, we can do all 3. We absolutely can. If somebody asks you for a burrito, right, don't give them a salad. Give them a burrito. Okay? You with me? All right. So you'll look at that the previous module, and what you'll see is that I really kind of I'm teeing this up to get into more detail. And slowly but surely, it's like building a house with the client. We built the foundation of trust. We've now kind of talked about their income gap. We've stoked a fire with their income gap. Now we're talking about the different ways you can invest your money, and we've let them decide which path they want to go down. So now that we've gone down that road, Ms. Jones, let's talk more in detail about some of the ways we can help you here at Allied Wealth or whatever your practice is. So the reality is what we ultimately like to do is to take a balanced approach between investments that offer risk or have risk in them and investments that are safe. So I love that. Hey, Ryan, There's a guy in the conference room. He came in from the seminar. He ordered a black cup of coffee. His wife's not with him. He sat down. He's got one piece of paper with him. Who is that? It's the rooster, right? He wants to show us how much money he's got and how good he looks, right? And what's he wanting to ask when I sit down and talk to him?
What do you charge?
What do you do? Just want to see what it is you do. Well, Jim, we take a balanced approach. Okay. Well, what's that mean? Well, what specifically are you looking for me to share with you? See, I've just taken the control away from this guy who's coming in beating on his chest by doing that, all right? Well, our balanced approach is taking between investments that offer risk potential and investments that offer safety. And that's the balanced approach. So let's talk a little bit more in particular about the risk side and the safe side. Because what you've just told me is that you like a tactically managed approach for your risk money. So let's talk more in detail about how we take that approach and how our managers take this approach. So what our managers are going to do is they're going to identify loosely correlated assets like stocks, bonds, commodities, real estate, international stocks, and cash. And what we are going to do is allocate capital to those different asset classes at different times based on what's going on with the stock market, with the economy, and with interest rates, because those are the driving metrics to the stock market overall in most cases. Now, what we've also known is that depending on where the market is and how your capital is allocated to these various asset classes, that is the key driving metric to the performance of your portfolio to the upside and, more importantly, to the downside. So let's talk about how we move capital around these different asset classes and kind of why we do that. So to move the money around the different asset classes at different times, we look at economic indicators. Economic indicators are things like housing starts or interest rates or jobless claims, all right? Well, if I'm seeing interest rates go up, okay, and all of a sudden it's more costly for people to borrow money to buy a house, you'll likely start seeing housing starts go down and home sales go down, right? What does that tell you about the real estate market's outlook? Probably going to start going down in value. So would it make sense to maybe move assets away from real estate in that environment? Would that make sense to you? Yeah, it certainly would, all right? Or we could look at fundamental indicators. So let's assume the stock market has 500 companies in it, okay? And in those 500 companies, they're all required to report earnings on a quarterly basis, all right? So let's just say that only 100 of those 500 companies are reporting good earnings. Is that a good or bad sign for the stock market? It's a bad sign. So would that be appropriate to be buying more stocks at that point in time, or lightening up on stock positions at that point in time? And the answer is likely lightening up on stock positions, okay? Or we can flip the coin over and say, all right, well, there's 500 companies in the stock market, and 400 of those companies are reporting good earnings. Is that a good or a bad sign for the stock market? That's a good sign. I'm actually asking these questions. I'm keeping the prospect engaged, and I'm wanting them to respond to me. I'm not just saying, yeah, it's a good sign, and keep on steamrolling right over the prospect, all right? So they'll say it's a good sign. That's exactly right. So in that scenario, we might want to allocate capital to more stocks, all right? The other one we can look at are technical indicators. So technical indicators can be very complicated. They can also be very easy to understand. And here's an example of a technical indicator. The stock market has what we call moving averages. So you have a short-term moving average and a long-term moving average. Well, as long as a short-term moving average and the long-term moving average are both going like that, that's a very good sign. And guess what? It's not just the stock market that has that moving average, it's the bond market. It's the real estate market. It's the commodities market. It's gold. They all have moving averages, and we can take this metric to any one of these asset classes. So the moment that the short-term moving average falls below the long-term moving average, that's a very bad sign for whatever asset class that's happening in. And it might be a good idea or good indicator to lighten up on that asset class or move away from it entirely. And when the short-term moving average goes back above the long-term moving average, we start going back like that again. That's a very good sign for that asset class. Now that we have an understanding of why the methodology for moving money around these different asset classes at a given time, we can talk a little bit more about kind of what we do in this methodology. And the first thing we have to understand is that we build a series of portfolios based on risk-adjusted return, meaning how much risk are we taking with your money to get the return that we're getting, and more importantly, is that level of risk acceptable to you, and are you comfortable with it? So on a risk-return curve, there are portfolios that move out on a curve. And we'll start with this portfolio here that's a very conservative portfolio, low risk, low return. And this is a portfolio that would be similar to a turtle, okay? It's not going to have 30% returns, but it also should never have 30% losses. And as you move across the risk-return curve, you can get more and more aggressive to where this portfolio here has the highest level of risk, and therefore you get the greatest potential return. Now, most people will wind up in something called a balanced portfolio right here, okay? Now, if you look at a balanced portfolio and you just look at the typical balanced portfolio, which would be 60% stocks and 40% bonds, there's a couple of things you should know about that portfolio. The first thing is that the average annual return of that portfolio over about a 10-year period, the last 10 years, is about 7%. And the drawdown, meaning the peak to trough loss in that portfolio, is about 20%. All right, so if you're going to be balanced, you got to be okay with a 20% loss. All right, so is there a way to mitigate that? And the answer is you can move up and down this curve all you want to, but as you move this way on the curve, you sacrifice return. As you move this way on the curve, you subject yourself to higher losses. All right, so there's some ways that we can manage around that. And one of the ways we manage around that is that we have 6 different modes of investing. So that's 6, 1, 2, 3, 4, 5 of investing. And these modes are kind of based on what the stock market is doing, what the economy is doing, what interest rates are doing. All right, well, here's what's interesting. In this balanced portfolio, in the confines of the risk-return expectations, meaning how much risk we're taking with your money to get the return we're trying to get, what we have the ability to do is move up and down these modes. So for example, in a balanced portfolio, if we see a 2008 and 2009 scenario going on, we might move the mode of investing down to this, what we call 2008-2009 financial crisis mode of investing, okay? What that does, by the way, is it allowed us to be in a position in our balanced portfolio to not lose one dime of our clients' money in the 2008-2009 financial crisis. We're quite proud of that, by the way, all right? Now, the other side of it is we might want to be in the same balanced portfolio, but we really want to maximize return. So what we might do is we might move up the mode to that one right there, to where we're maximizing and getting as much return as we possibly can in that market environment, that economic environment, in that rate environment. And that allowed us to pull in a 21% return in our balanced portfolio last year in 2017. So we're able to minimize losses by doing this in an 08-09 scenario. We're able to maximize returns by doing the same thing in a 2017 scenario where the market returned 31%. Now, Mr. Jones, I'm just curious. I'm kind of looking at where you are right now. I'm just curious, is your advisor managing your money in this capacity? Because from what I'm seeing here, I don't think that they are, all right? And you deserve better than that. You deserve better than this, okay? Now, it may not mean that your advisor doesn't know what they're doing. It simply means that your advisor may not know how to do this type of money management, and that's where we add a lot of value because we are fiduciaries. And we're required as a firm to go out and survey the marketplace for the best money managers we can find every single year, and we simply team with the best. The reason why we team with the best is very simple. Remember the first part of the presentation where we were talking about wholesale versus retail financial services? and as your account grows, our fee goes up and we make more money as you make more money, well, that's very important to us. It's also very important for us for our account values to not go down, right? And we don't want the huge losses to occur because as you lose money, we lose money too. Now, the last thing I'll spend some time on is you might have heard me mention a minute ago a word called drawdown, all right? It's very important you understand what that is. Because with drawdown, here's what happens. Let's say your portfolio starts at $100,000 and grows up to $200,000 over time. And then we hit a rocky road in the market and your portfolio drops down to, say, $160,000, okay? And then your portfolio starts going back up again over time, all right? Well, what you call this peak to trough loss right here is a drawdown, all right? And this drawdown is a 20% drawdown, okay? And we want to minimize that drawdown as much as we possibly can. So in the scenario here, in all of our portfolios, what we are seeking to do is minimize drawdown and maximize return. And I've shown you exactly how we do that. Do you have any questions? All right, now, I want you to understand something. On the risk side of this board, we are fee-based. Our fee range maximum is 2%. I am not saying you're going to pay 2% for us to manage your money, but that is the maximum fee a client would pay us, okay? And again, your money is held with a qualified custodian such as TD Ameritrade. You open your account at TD Ameritrade, it's your account, your name. You log into TD Ameritrade's website to check out how your accounts are doing. You get a check, it comes from TD Ameritrade. You guys are kind of getting the feel here, all right? So, the next thing is the safe side. So, I actually do this safe side two ways, and I'm going to show you both ways, okay? The first thing that I do on the safe side is I talk about, this is one avenue you can go down, and I talk about safe money. That's okay. With safe money, you have bank CDs. Bank CDs right now are paying about 1% to 2%, and your money in a bank CD would be committed for a period of 1 to 3 years. I don't recommend going longer than that on bank CDs because if rates go up, you don't want to be be in a position to take advantage of rising rates, all right? Then you can go into the 10-year Treasury. And the 10-year Treasury, interestingly enough, is considered to be one of the safest investments in the world. But guess what? It's not always safe. And here's what I mean. Right now, a 10-year Treasury will pay you almost 3%, and your money would be committed for a period of 10 years to that program, okay? And here's what I mean. There's a common thread between bank CDs and Treasuries. The first thread is they're considered to be the safest investments in the world. Second thing is that neither one of them provide you liquidity in retirement. You cannot access your money in a bank CD without paying a penalty. And the only way to access money in a 10-year Treasury before the 10-year term is up is to sell the 10-year Treasury. But if rates go up, you will not get what you paid for that Treasury, and therefore, for that reason, Treasuries are subject to this thing called interest rate risk, and it can really hurt you over the long term. Now, make no mistake about it, you hold the investment to its term, you're going to be okay. But keep in mind, there's a common thread between bank CDs and Treasuries, and that thread is that they do not offer any liquidity during the term without penalty or potential loss of investment. Why did I say that? Interesting, all right? So the next thing we can go into is a fixed annuity. Now, when I say the word annuity, a lot of people clam up and they get all this fear because they've read out there on the internet that annuities are bad, okay? Well, a fixed annuity is actually the insurance industry's version of a bank CD. And they were designed over 100 years ago to directly compete with bank CDs. And that's exactly what they do. So with a fixed annuity, you can earn a rate of return of anywhere from 3 to 5%, and your money would be committed to that program for anywhere from 4 to 7 years. Now, what's really neat about a fixed annuity over a Treasury or a bank CD is that during that 4 to 7 year period, you have access to your money. If you want to take money out to buy yourself a car, you can do so. If you want to take money out and take your grandkids to Disney World, you can do that too. Or if you want to take money out for monthly income payments, you can do that as well. You have access to your money when you need it. You're getting the same level of safety in a bank CD and a Treasury The difference is if you want to get your money, you can get your money without penalty whatsoever. All right? Now, Ryan, I've heard, what I'll kind of say here is that just depending on where the client is, I'll say, a lot of people have heard bad things about annuities. They hear that they have high fees. There are 0 fees on a fixed annuity. They've also heard that they die in that 4 to 7 year period, that the insurance company will keep all their money. In a fixed annuity, that's absolutely not the case. There are annuities out there that do that, but a fixed annuity that's not the case. So are we clear on that? And I'll make sure that they're clear on that, okay? I don't always go into that. It's kind of a feel thing, right? But it's a good ammunition because they are likely thinking it in some capacity. So the last vehicle you can go into is called the fixed index annuity. And in a fixed index annuity, you can earn a rate of return of anywhere from 4 to 8%, and your money would be committed to that program for anywhere from 6 to 10 years. Again, that's Texas, by the way. If it's 12 years, just put 12 years in there, okay? So anywhere from 6 to 10 years, all right? So just like a fixed annuity, and I'll make sure you say this, it's very important. Just like a fixed annuity, you have access to your money when you need it. If you want to take money out to go take your grandkids to Disney World, you can do so. If you want to take money out to go buy yourself a car, you can do so. If you want to take money out for monthly income payments, you can do so. In addition to that, if you die in that 6 to 10 year period, your family gets all your money, no questions asked. And guess what? On a basic fixed index annuity, there's no fees either. No fees. No fees either. All right, pretty cool, okay? And so where I will go next is here. Mr. and Mrs. Jones, like many people who have sat in this chair before you, you're probably starting to wonder how much money you should have in a risk position and how much money you should have in a safe position, all right? So what I'm looking at here is a concept we call the rule of 100 that we're taught in Financial Planning 101. And what we're going to do is subtract the average of your and your husband's age from the number 100. And let's just say that number is 65. So 100 minus 65 equals 35. Those two numbers represent very, very significant factors to you. And those significant factors are the amount of money you should have in a risk position at this point in time versus the amount of money you should have in a safe position at this point in time. So what this says is that 35% of your money should be at risk and 65% should be safe. Now, right now, when I look at your 401k is invested in the stock market, right? Does the stock market have risk? Yes, it does. Does it make sense, based on the rule of 100, for you to continue to take risk with 100% of your capital? No, it doesn't, right? Mr. Jones, I'm also looking at another factor. When I kind of look at what's going on here in the lay of the land of your accounts, I'm seeing that you're all in the stock market at risk. How much of your money are you willing to lose today? Well, none. Well, does it make sense that you have 100% of your money on the risk side? So what we're identifying here is you're kind of out of whack with this risk versus safe, according to the financial planning concept, the rule of 100. Not according to Ryan Wheless, not according to you or what you think, it's according to what the rule of 100 says. All right, because again, we're leading the client down a path to make a decision for themselves, not telling, all right? So I'm not advocating here to put 65% of your money on the safe side or 35% on the risk side. I was trying to explain to you kind of the methodology that most financial planners use to take a balanced approach between risk and safety. But to that end, if the rule of 100 says that you should have 65% of your money on the safe side, which one of those investments would you choose?
I like the fixed index.
And how are they going to go anywhere else? And that's reality up there, guys and gals. That is the lay of the land where it sits today. All right. So where I come in and say, okay, listen. If you're telling me fixed index annuity, you probably would like to have more information on that program. Yes, I would. Okay. Let's kind of talk about what happens in a fixed index annuity. So what's going to happen is we're going to put $100,000 of your money into a fixed index annuity. And these vehicles are safe, so once your money goes into the account, your money is safe and protected. Under no circumstance can you lose it, and the only way the value could ever go down is if you take money out and go spend it. That's it, all right? Now, what we're going to do is we're going to give you protection periods. And the protection periods are 2 years long each. And protection period number 1 starts day 1, the day you put your money into this vehicle. Now, we're talking about how we protect the money. But protection of the money is important, but we also need some growth. So how do we grow your money? Well, the way we grow your money is use an index put out by Barclays Bank called the 𝘂𝗂𝗂𝗧 Index. The 𝘂𝗂𝗂𝗧 Index is designed to produce somewhere between a 6 and 8% return per year over a 10-year period. And it's done a pretty darn good job of doing that in the past. So the goal here for 𝘂𝗂𝗂𝗧 is 6 to 8% per year, okay? Now, let's just talk about taking the middle of the road number, the 7% number there, right? Somewhere between 6 and 8%. And let's just talk about what happens if the 𝘂𝗂𝗂𝗧 Index has a positive return year 1 and year 2, right? Your account value is going to increase to about $114,000. Once you've reached the end of that first 2-year protection period, that 114 now becomes part of your principal. And just like your original principal deposit, it's protected from market losses, market crashes, and the only way that value can go down is if you and Mr. Jones take money out of the account, right? Now, let's say the next 2 years, the 𝘂𝗂𝗂𝗧 Index does something it's really not designed to do and typically hasn't done, and has 2 years that are negative, 1, 2, all right? What's going to happen is your 114 value is simply going to sidestep, and you're going to start that second 2-year protection period with, third 2-year protection period with what? 114. And you make them say it. And if they don't say it, they're not getting it. So go back and do it again. Make them say it. One of the best things you can do is get the client involved. Ask them the questions. And the reason why is you may think they're getting it, and the look on their face may make you think they're getting it, but they ain't. And the only way you're going to know if they're getting it is by what? Asking questions and waiting for a response. All right? So, you've got 114 there. Now let's say next year the index goes down 2 years in a row. I'm sorry, it goes up 2 years in a row, 1, 2. Well, your value would be about $130,000, at which time you've reached the end of that protection period, and your account value is now 130. And again, the only way that value can go down is what? And I'm asking them, okay? Because I've said it how many times now? A lot, all right? So next year, let's say the next 2 years, let's say the index goes up again, right? And you got, $150,000 here, all right? Well, now your value is at 150. The only way that value can go down is? That's exactly right. I like to say, take money out. Go to Disney World, buy yourself a car, okay? All that kind of stuff, right? And let's say that the final 2 years, the market crashes and 2008 repeats itself and the market goes down. Well, at the end of this program, or into that last protection period, you have $150,000. And if bank CDs are paying 10%, then you can take that $150 out and go put it in bank CDs and generate $15,000 a year in income. If they're not, and you like this program, because it's an awesome program, by the way, you can simply start another protection period and keep going. Notice there's 2 things that I've done. Did I say the word annuity through this, other than fixed index annuity, right? Did I say the word lock-in? What did I say?
Protection period.
When you use the word lock, what happens? Huh?
Get my money.
My money's locked up, right? That's one of the biggest objections for people buying annuities is they think their money's locked up, okay? All right, so now, Ms. Jones, I've shown you the good parts of this program. Let's talk about the negative, because there is no perfect tool of investing. And our negatives are very small here, but it's important that you know about them, all right? The first thing is this. To get the benefits of safely growing your money in this awesome program, add 2 plus 2 plus 2 plus 2 together, and you get 10. So to get the benefits of growing your money in this awesome program, there's a commitment of your funds on 10 years. It requires a 10-year time commitment, okay? But under no circumstance does that mean your money is locked up or you can't get access to your money or get all of your money back. You have access to your money when you need it to go out and buy yourself a car, to go out and take monthly income payments, or to take your grandkids to Disney World, all right? Now, let's talk about that access, because from year 0 to 1, you have 0% access. Part of that is because the way the company that offers this program is investing the capital to protect you, they need a year's head start, all right? In years 2 through 10, you have access to 10% of your account value every single year. So if you take out 10% this year, you can take out 10% next year and each year thereafter. Now, I want you to understand something. If you're taking out 10% of your account value every single year, you're about 12 years from going broke. So please don't do that, okay? Please don't do that. But the question becomes, what happens if you need more than 10%? All right, well, let's put that into context for a minute. And let's just say we're going to take a balanced approach here, all right? And let me back up. Hang on a second. I want to put that there or not. Let's see. Okay, let's say this. Let's say in years 2 through 10, you have access to 10% of your money. I had a different spin on this I was going to show you guys, but I don't want to do that. In years 2 through 10, you have access to 10% of your money, okay? The question that you don't know to ask me right now is what happens if I need to take out more than 10%? The question you don't know to ask me right now to say, hey, client, I'm on your side. I'm here to defend you. I'm here to respect you. I'm on your side, right? Is what if happens if I need to take out more than 10%? So you have a $100,000 account balance. The first 10% comes out, no issue whatsoever. Because why? Why does it come out no issue whatsoever? Because I have access to 10% of my money each year. Make them say that back to you. And if they don't say it, they're hung up somewhere. And you're not going to get the sale because the client doesn't understand what they're buying. Okay? So now the second $10,000, or if you called me up and said, hey, Ryan, I got $100,000 in the account. I've got to have access to $20,000 from that account right now. Got to take it out. Okay? Well, what happens is that second $10,000 is going to be charged a 9% charge. Okay? So that means $900 is going to be charged to get a $20,000 check out of your account. I want you to be very careful, all right? Because these programs have people that don't like them, all right? And the reason why they don't like them is they're kind of anti-Wall Street, and Wall Street wants you to keep your money in Wall Street so they can keep making money and living in these huge condos in New York and driving these fancy cars and having all this money at your expense, and they don't like this. So they try to put a lot of negative out there. And what they want you to think about that 9% charge there is that there's a 9% charge on the entire account value, okay? So what's your account value? It's $100,000, right? What did you charge? What did you pay to get an additional 10% out for an emergency? $900. If you have a $100,000 account balance and you paid $900, what's that in the form of a fee? 90 basis points. Okay, it's very important that you understand these things. All right. Now I'm not sure which path we're going to get down here, if this is even for you or not, but at least you'll have a good understanding about how these programs work, and you can make a decision to go into this or not go into this based on 100% fact. Okay? What I do there, I just took the person who's anti-annuity and took their guard down, didn't I, by saying that? Okay? Now, so that's how you get the $20,000 out. And by the way, what's really nice about this is this schedule goes down each year towards zero at the end of the 10th year, which means from year 10 on, you have access to 100% of your money. So, we understand this. Now, you asked me earlier what we like to, when we sat down earlier, what I shared with you is I take a balanced approach between risk investments and safe investments. And you told me when we talked about out of the market, in the market passive, and in the market tactical, that you liked the out of the market and you liked the tactical approach. And that's exactly what I've shared with you today. All right. But there's one thing to this. This rule of 100 thing, I don't like it. It puts too much money on the safe side. Too much money over there. I'm not comfortable putting 65% of your assets in one vehicle. What did I just do there, by the way? The husband's sitting there going, there ain't no way in hell I'm putting 65% of my money in any damn thing. But when I took that back, he's going, I just disarmed that, didn't I? And you guys are nuts if you think they're not thinking that, because they are, okay? So I like to take a balanced approach, 50, 50, exactly that. Why am I comfortable doing that? I'm comfortable doing that because the way our money managers manage money and how well they did in the 01-02 crash and 08-09 crash and that sort of thing, and how their methodologies work through those things, and the way they limit the drawdown in their portfolios to, try to about 10%, which they've done very, very well at doing, I'm okay with taking a balanced approach. And here's what else it does for you. So you've got $1 million, Mr. and Mrs. Jones, all right? And so here's the way it's going to kind of look. Here's $1 million. What we're going to do is put $50,000 in cash savings. That's going to be an emergency fund. We're going to take the balance of $950,000 and we're going to put $425,000 over here on the risk side. We're going to put the other $425,000 here on the safe side, okay? So let's go back to this whole thing down here, once you're probably still thinking about how to get money out of your accounts and how this would all work, all right? The reality is I don't have any clients taking these types of charges. And the reason is because I'm putting you in a great position from the get-go, all right? We'll get more to that, why that's a great position here in just a second. And here's why it works so well, because this. You call me up and say, Ryan, I got the biggest emergency on my hands I've ever had. My house burned down, my grandchild's sick, my son got his car repossessed, and my wife's ill. Well, that sucks. You might need some money, okay? Well, here's how we get the money. You see, you've got $50,000 in cash savings here. You've got $425,000 in cash savings here. You've got access to 10% of this $425,000 here, okay? So let's add that up. That's $475,000. That's almost $500,000 of money you can get your hands on anytime you need it. Mr. and Mrs. Jones, I'm just curious, when is the last time you wrote a $500,000 check? And if you haven't, that's okay. If you haven't, that's okay. What it does tell us, though, is that the $500,000 of liquidity that this plan will offer you, okay, should be ample liquidity for you. And for that reason, we don't have issues over here with clients taking these types of charges. Now, here's Module 5. Module 5 works like this. You've got risk and safe money. We've got I'm going to just do $500,000 to make this math easy, guys and gals. We've got $500,000 over here. We've got $500,000 over here, okay? Let's talk about costs, all right? So I told you my fee is 2%, okay? Well, one thing I didn't do that your question got me off on is, by the way, Mr. and Mrs. Jones, there are no fees on this program at all, no fees whatsoever. And I don't charge a fee on top of these as well. We don't charge management fees on the safe side. And I do earn a commission on this program. And my commissions on these programs range from anywhere from 5 to as much as 9% upfront day one. And what's nice about that is you don't ever have to pay me any fees on that. And that money does not come out of your money, it comes out of the insurance company's future profits.
Whoa, did I just tell them I'm gonna make $9,000 as an annuity sale?
Yeah, I did, right? Why should I? Because you're required to. That's why. To cover your assets. That's why. In addition to that, something else I may say is, look, there's annuities out there that pay higher commissions. What that results in is less money for you to make money on. I actually want to focus on the ones that pay the highest returns to my client and a little bit lower commissions. So most of the ones that I put clients in pay me about a 6.5% commission upfront day one. And again, it does not come out of your money, it comes out of the insurance company's future profits. Well, how can the insurance company do that? All I've got to do is recoup about 0.6% a year over the life of this program, and they make their money back. That's how they can do it. All right? Now, so cost. On the risk side, you're going to pay $10,000 per year in fees. On the safe side, I'm commission-based. We already talked about that. And there are 0% fees, okay? Which means you're paying nothing. Here's my question to you. How much money are we managing for you here? What are your fees? $10,000 a year? What's 1% of $1 million? And if your fee's lower, it looks even better. You with me? Okay. Now, I will also kind of recap liquidity. So again, you have $500,000 here, $500,000 there. If you have a liquidity crisis and need to get your hands on some money, you have access to $500,000 here. 10% of this over here is $50,000. Right? Add these two numbers together, and you have $550,000 of liquidity anytime you need it. Is that enough liquidity for you? Yes, Ryan, that's enough liquidity for us. All right? The final thing is the most important thing. I call this part the LC. And clients go, what's the LC? Right? So here's what I say. The way you're currently allocated, you've got $1 million. All your money's at risk, right? And if we have another major market correction like we did in 08 and 09, and by the way, you will see at least 3 more of those if you're age 60 in your lifetime, 3 more, okay? If that happens again, the way I'm looking at your money and how it's currently allocated, you're likely going to go down about 40% to $600,000. That's where you are currently. What I specialize in doing for my clients is a little bit different. Let me ask you a question. You're wondering what LC means. LC means lifestyle change. So if your portfolio value dropped from $1 million down to 40% to $600,000 in retirement, would that cause you to consider a lifestyle change or go back to work? Yeah, it would, okay? Well, what we do here, by taking a balanced approach between risk investments and safe investments, so we have $500,000 here at risk, $500,000 here is safe. Let's say this market crash happens again. Well, our portfolios are designed to draw down about 10%. So you're going to go down 10% to $450,000. On your safe investments, how much money can you lose? None. So by allocating your capital the right way, you have $950,000 in a 40% market correction. Ms. Jones, I'm just curious, which one of these would you rather have? Ms. Jones, Mr. Jones, would you like me to help you take a lifestyle change in retirement off the table permanently in your golden years? To get this process started is very easy. All I need to do is make a photocopy of your driver's license. Do you have that with you today? That's a trial close. Why am I telling you that? I'm telling you this because I have the ability to close almost 50% of my business in one appointment. It's very difficult to do, and sometimes by doing that, it screws up the process, okay? There's another reason why I'm telling you this, though, because I learned this the hard way. And here it is. If the person gives you an objection, they're going to say, well, we're not there, you know, or you kind of looking at the husband and wife. They can whip out the driver's license, get the damn driver's license, and go to work, okay? If they don't, here's what they want. The husband doesn't want to look stupid in front of you. The husband doesn't want to look stupid in front of his wife. The wife doesn't want to look stupid in front of you, and the wife doesn't want to look stupid in front of the husband. And what they really want is just a few minutes to enjoy the confines of the sanctity of marriage and have a communication amongst themselves. So Miss Jones, tell you what I'm going to do. I'm going to step out of the conference room, and I'm going to give you guys a few minutes to talk. Okay? And when I come back in, we'll figure out what to do next. So get your ass up and walk out. of your conference room and set your timer for 10 minutes. Do not go back in that conference room before the 10 minutes is up. I will beat you, okay? I have literally had people walk out of the conference room with a pen within 8 minutes. Why do we do that? I would rather them do that in my conference room than the first 8 minutes they're driving away from my office in their car. Right? Because what are they going to do in that first 8 minutes in the car? They're going to make a decision to go with you or not go with you. Right then, that decision's made. I'd rather have them in my conference room making that decision instead of driving away in their car. Because that way, if the decision is no, I know it. Because I'm going to go back in and say, okay, Mr. Jones, what questions do you have? Well, Ryan, I don't like the fact that we've got 50% over here at safe. I'm a risk taker. I got a big pension. I'm just not comfortable with that. How much money are you comfortable with having on the safe side? None. Awesome. To get this process started, all I need to do is make a photocopy of your driver's license. Do you have that with you today? I don't care, right? I make money, sell and manage money or annuity. I don't care. I'm just here to make money and serve clients, okay? Now, let me pause here, okay? I just showed you how to go for a close, all right? And if I get from that point, if I get still a resistance, what I'm going to say is this. Mr. Jones, I've done you a bit of a disservice today. Put some mud on me. I've not given you enough information to make this decision. So here's what we need to do. We need to go a step further, and I need to take this methodology and this information. I need to take the stuff that you told me you were comfortable investing your money in, and I need to build for you a written comprehensive financial plan. And we're going to do that, and I want to have you come back in Wednesday or Thursday of next week, and I want to present to you the written comprehensive financial plan. And I want you to know something. We spent a lot of time together here. We're going to put a lot of time in this plan. If you come back in and you don't like what I've shown you, you don't feel we're a fit, I want you to tell me. And if I don't feel like you're a fit for us, I'm going to tell you that too. And I'm okay with you telling me no. But at least going to this next meeting and doing this planning session will give you the ability to either make a decision to come on board with us based on 100% fact, or make a decision to pass on working with us based on 100% fact. And I can't think of a smarter way to approach investing your life savings. All right? Now, we're trying to get to a process as a company, an organization, right? You may not be comfortable going for that driver's license. And I've heard people butcher that so bad. Miss Jones, I need a copy of your license. Is that what I said? It's not what I said. Miss Jones, do you have your license? That's not what I said. No. I very eloquently said, Mrs. Jones, to get this process started is very simple. All I need to do is make a photocopy of your driver's license. Do you have that with you today? You got your license with you? You know, you see there's a huge difference. It's not what you say, it's how you say it, okay? It's very important. All right, now let's say that you're not comfortable doing that, okay? And it's okay if you're not. Don't, okay? What you're going to do here is this is the end of the second appointment, depending on how far you got, how much time you got in the first, who knows? But this will be the end of the second appointment, all right? And so basically what's going to happen is you've already told the client there's a 3-appointment meeting process. We have an advanced agreement from the client to go to that third meeting, don't we? Remember that? Okay? So, Mr. Jones, here's what's going to happen next week. I've shown you what we can do for you, but what I have not shown you is some very important stuff. What I've not shown you is how well, based on what you're trying to accomplish, what you're currently doing will work for you. I mean, why make any changes to what you're doing at all now, right? I know you're here because you've reached a trigger point or something's happened with your current advisor that's got you some concern, but let's test what you're currently doing to make sure if we're going to make any changes, we are in fact making good changes for the right reasons, not just blindly doing it. Does that sound smart? Yes, it does. The other thing I'm going to do is I'm going to test your current portfolio against a straight up Vanguard 60/40 portfolio, something that you and Mr. Jones can go do without working with a financial advisor at all on your own, not pay any fees whatsoever, and let's just see if that'll work for you or not. Does that sound like a smart idea? I'd like to know if I go do this on my own and not have to pay any fees, don't you? Sure. And then what we're going to show you is any idea, what we're going to show you is what applying our methodology will do to your situation and the probability of success on that situation. And I want you to tell me now, if there's anything out there you have thought about investing your money in that we haven't talked about that you'd like me to test for you as well. Well, Ryan, I got this guy trying to sell me this cash value life insurance thing, you know, or I thought about buying real estate investment trust, whatever it is. Okay, cool. We can kind of incorporate that into the overall plan and test it and see if it's something that makes sense for you to do. So I'm looking forward to next week. I'll see you Wednesday. The meeting will take a little bit less time, about an hour to an hour and a half. And again, I want to remind you, if next week we get here and we show you the plans and show you all the stuff we're going to do for you, if you feel like we're not a fit, I want you to tell me. And I'm okay with you telling me no. And if I feel like in that planning process, I feel like you're not a fit for us, I'm going to pay you the same respect and do the same. Is that fair? Yeah, it is. Look forward to seeing you next week. You guys, you start putting just that little stuff in your presentations and it'll go through the roof.